Hello, everybody. This is Paul Forchione. Thanks for joining me for today's webinar on iron condors and iron butterflies. What I'm going to do is to share my computer monitor with you so you can see how I work with OptionVue when I create and modify these types of positions. What I'd like you to do is to feel free to type any questions that you may have into the chat window as I am making my presentation. And what I will periodically do is check that and respond to whatever questions you happen to have. What you should be looking at right now is my quotes display for OptionVue. And I am getting real-time quotes, so you will see some of the prices for the future and the options change as we're working with the material. But that's good because it makes it realistic. And rather than freezing the frames, freezing the prices, I'm going to leave it on real-time quotes. What I thought I would do is start by working with the gold market. It's the one that I've highlighted here. GC is the symbol for the gold futures contract. What I will do is click on the matrix button to show you all of the various futures and options that are available in gold. And we will start off by discussing an iron butterfly in the gold market. Well, what is an iron butterfly? Well, an iron butterfly is an option spread that has the advantage of collecting a large credit. It requires low margin. It's a position with limited risk. And it can be established or constructed in such a way that it is either delta neutral starting out, delta long, or delta short. So there's a lot of flexibility there. And the definition of an iron butterfly that would be neutral on the market would be the following. If we take a look at the March options that are available for trading with 29 days to expiration and the Aprils with 57 days, let's initially start off with working with April options. And an iron butterfly that's neutral would be the sale of an at-the-money straddle. So the at-the-money strike price would be essentially the 1665 strike price, where we would sell a call and we would sell a put, both with the same strike price. That's the sale of an at-the-money straddle. And what we would then do is purchase an out-of-the-money call, and we would purchase an out-of-the-money put. And what I'm doing is, you'll notice the out-of-the-money call that I purchased is 35 points out of the money. So if I go with a put that's 35 points out of the money, that would be the 1630 put. What we're really looking at is a short straddle at the money, which is called the body of the position, and we are long the wings. We're long the 1700 out of the money call and long the 1630 out of the money put. That would create an iron butterfly. If you look at the Greek variables underneath the quotes display, or underneath the matrix rather, you'll see that the deltas are very close to neutral, very small neg gamma, which tells us the deltas don't change much as the market moves. The theta, or positive time decay in dollars per day, is about $3.77. And then there is vega, the sensitivity of the position to changes in implied volatility. It's minus 44. That's $44 of impact if implied volatility either increases or decreases by 1 percentage point. If we look at the graphic analysis, and if I highlight today's T+0 line in red, what you will see is a visual representation of how this iron butterfly can perform, not only as time goes by, but also as the market moves, either higher or lower in price. This is a typical graphic analysis shape in the sense that it looks like a witch's hat with a peak. I've got 4 performance curves shown on this graphic analysis. The T plus 0, one in red, is today. If I'd click on T plus 19, it would give us the performance curve that shows us how this trade performs in 19 calendar days. T plus 38 and T plus 57 is expiration. So clearly, what you notice by looking at these 4 performance curves is that it's a slow performer starting out. It's going to take almost 2.5 weeks to see a little bit of profit on the trade from positive time decay, provided that the market stays in a rather constrained range. And then the difference, or the distance, from the third performance curve in comparison to the second is a little bit further away, because time decay, positive time decay, grows with the passage of time. And in the remaining 19 days between T plus 38 and T plus 57, there's an enormous amount of positive time decay that can generate very large profits if the market does in fact stay in a relatively constrained range. The purple dotted line here on the left comes in at approximately 1637, or 1636 rather, and the break-even point at expiration on the upside is 1693. So you'll notice how those purple break-even lines do change. They get wider as we go to expiration, and they excuse me, they're narrower when you click on the performance curves that are closer to the current date. So the reason that people like this trade construct is because you do have absolute limited risk. And that limited risk is defined by the loss that could be incurred at expiration in essentially 2 months. In this case, the maximum loss is about $680. If we look only at the 38-day line, maximum risk is only way out at the extremes here, with about a $100 drop in the market, or with about a $100 rally in the market. Now, I chose strike prices that were 35 points apart from one another in constructing this trade. Watch what happens if we go back to the matrix and we widen this out. Let's say that instead of buying the wings at the 1700 level, we buy it at the 1725 level. And what if we also widen the wing on the downside? Instead of at the 1630 level, we go an extra 25 points away, and that would be the 1605 level. Now what we've done is we have created a wider butterfly that has a wider range over which it can make money as time goes on. We've sort of spread out this curve so that it has a not so narrow. As you can see, this is a narrow witch's hat. This one is a little bit broader. The margin on this one is $859. The margin on the initial one that we looked at was only $326. These are very, very low figures, especially when you relate those to possible projected profits as time goes by. Here, when I highlight the T plus 38 line, essentially a month and a week, 5 weeks from now, you can see that the profits in a narrow range can be as high as, say, $900. $900 in relation to the margin of $859 is greater than 100% return. What you can do is change the vertical axis from profit and loss in dollars to yield, and it will show you your possible projected yield over various ranges and prices. So that's the other thing that makes these positions attractive, is the potentially high return on margin in a relatively short period of time. Now, of course, we do need to be very cognizant of the fact that even though we're making positive time decay by holding this trade, we are vulnerable to two possible things. One would be that the market either drops or rallies in price significantly, and that's why these performance curves do have a concave downward or a negative slope to them. And the other thing we have to be aware of that's a disadvantage is the fact that the Vega factor is rather large in relation to the theta factor. In other words, the sensitivity to implied volatility is, in this case, about 10 times as important as the daily time decay. It could take 10 days of positive time decay with the market not moving in order to compensate for an unfavorable change in implied volatility of 1 percentage point. Because a 1 percentage point increase in implied volatility would lead to a loss of $114. 10 days of positive time decay would essentially be $110 of income that would offset the loss from the Vega. So the sensitivity to volatility is quite high in relation to theta, 10 to 1. That's starting out. If we look at the projection in 19 days or in 38 days, the ratio becomes much smaller. Even though the Vega gets increasingly large at an unchanged level, minus 139, the theta grows to 41. So there the relationship is about 3 or 3.5 to 1. So the sensitivity to volatility is not a big issue as long as the market doesn't move too much over time and as long as we can see that positive time decay come to fruition. I do see that there are quite a few questions here. Let me just take a look at these here. Sound and screen resolution is very poor. Screen is barely visible. Audio is impossible. Okay. One of the participants unchecked the fit to window, and that helped with the audio, or that helped with the video. Another one says the sound and the screen are fine. For those of you where the screen is too small, do uncheck the fit to window button, and that should hopefully help you there. Let's see here. There's also the full screen option in the upper right that you can go to and click. That should help. Okay. Let's go back to my screen sharing and continue the process here. So we're looking at an iron butterfly where I showed you if we widen out the wings, we can broaden the graphic analysis. Now, if we were to contrast this to an iron condor, you will see how we can broaden this graph out even more. Remember, what we're looking at here, if I told you we are looking at an at-the-money straddle that is short, that we sell, and then we put in the wings, our insurance that we buy with an out-of-the-money call and an out-of-the-money put. And that makes a neutral iron butterfly starting out. Now let's take a look at a neutral iron condor. The only difference with an iron condor is that rather than selling a straddle, we are going to sell a strangle. We're going to sell an out-of-the-money call. So let's go ahead and sell, for example, the out-of-the-money 1675 call. And we're going to sell an out-of-the-money put. So let's go ahead and sell the 1640 put. We'll leave our insurance pretty much where we had it. Let's change the out-of-the-money put to be the 1600. So that makes a 40-point difference between the short put and the long put. If we do the same with the calls, that means that our long call would be 40 points out of the money from the 1675. That would make it the 17.15 would be the call that we would purchase. So now we have a short out-of-the-money strangle hedged with our wings that are out of the money, and we have a graph that looks like this. And the big difference, of course, in the picture is at expiration, we have a flat top defined by the strike prices of the put and the call that we have purchased for insurance. But in terms of how the trade will perform as time goes on, it looks very similar to the at-the-money iron butterfly that we were looking at before. It looks very similar. As a matter of fact, if we were to look at the projected profits in 38 days, you can see that we have a wider range over which this trade can make a reasonable return on investment. If I change it to yield on the x-axis, you can see that even with a rally in the market on April gold from 16.55, the current price, up to 16.91, there still is an opportunity for a 32% return on margin. And similarly, if it drops down to 16.19, a 37% return on margin, which happens to be, in terms of dollars, $250. So the only real visual difference is the flat top. You still have negative vega. You still have positive theta. Now, what I've really shown you is an iron butterfly and an iron condor that are neutral starting out. Perhaps as a trader, you don't want to assume that the market is going to be neutral. As a matter of fact, if you click on the price chart in the upper left corner, you get a visual of, I have a bar chart of historical prices on gold, and of course OptionVue displays a continuous chart. This is not a specific month of gold futures, but it's a composite that weights the most heavily traded and the front months more than the deferred months. But it gives you a pretty good idea what gold is doing. Given this, you might want to put on a bearishly oriented gold position going forward. I'm going to superimpose by clicking this double squiggly line in the upper left with the implied and statistical volatility lines. It shows us that the blue implied volatility has been trending lower over time, over the last several months. And as a matter of fact, it is at a very, very low level when you look at it from two different measures. It is currently at 10.9% for implied volatility. And the number 3 in brackets following the 10.9% that you see at the bottom of the screen here tells us that the 10.9% reading is in the 3rd percentile over the past 6 years of readings. So in other words, 97% of the time over the past 6 years, implied volatility on gold options as a composite have been higher than this. Definitely it's telling us implied volatility is low from a historical perspective. And when you look at the implied volatility, the blue line in relation to the brown line above it, it's telling us that implied is less than statistical volatility. Statistical volatility is 12.3%. Statistical volatility is a measure of how volatile gold futures themselves have been. Implied volatility is a reading that tells us how the options traders are assessing their expectations for how volatile gold will be going forward in time. So clearly, options traders are not expecting gold to be very volatile, and they're even expecting it to be less volatile than the market itself has been moving lately. So we have two different measures of, you could say, low implied volatility in gold. The first one is the fact that the implied is in the 3rd percentile. That's a very low reading. And the second reason implied is low is because the current 10.9 reading is less than the statistical reading of 12.3. So it's low on both counts. You could say that that is a reason to be concerned with this particular trade structure because we have a negative Vega factor. And the negative Vega factor means we get hurt if implied volatility rises. And we would expect that in time, implied volatility will rise because implied volatility does tend, over time, to gravitate toward a more average or mean level. It's telling us we should be cautious of implied volatility rising, and that would cause a negative performance on this trade. If implied volatility were to rise just 2 percentage points from 10.9 to 12.9%, we can put that volatility change here on the left-hand side of the screen, and it will build in the negative impact of the Vega factor times 2, and it will lower our projected profit and loss. It changed from $830 to $610 at an unchanged level. Now, there are ways that you can deal with this negative Vega factor. And one of the ways you can do that is to do the following. Imagine instead of putting our protection with the out-of-the-money put and call in the same month, imagine that we instead put that protection in a month that's further out in time, in this case in May. So instead of buying the April 17-15 call, we're going to buy the May 17-15 call. And instead of buying the 1600 put in April, we're going to buy it in the month of May. Look what that does. It changes, when you look at the bottom of the screen, the Vega factor from minus 114, now it's positive 53. It doesn't change the shape of the graph significantly, but it changes the dynamic, the performance dramatically in terms of how sensitive this trade is to implied volatility. In 38 days, that sensitivity grows to a positive 103. When we were looking at our traditional position, after 38 days, the Vega's minus 118. That's a huge difference. Minus 118 versus plus 103, huge difference. Now we are benefiting with this, I call it a calendarized iron condor. We are benefiting with an increase in implied volatility rather than getting hurt by it. So you do have the flexibility of deciding whether you want to calendarize your position because you want to benefit from a rise in IV or not. And if you also look at this, what I call calendarized iron condor, you can also describe it as a diagonal calendar spread with calls. It's a diagonal calendar spread because we're short the April 1675 and we're long the May 1715. That's a diagonal calendar spread with calls, just like we have a diagonal calendar spread with puts. That would be the way that you could change your sensitivity. If we go back to what we had originally, what we really had originally was a credit spread with calls and a credit spread with puts. So by changing those credit spreads into diagonal calendar spreads, you can change your volatility sensitivity. And there's no reason that you have to choose the same strikes. You could choose further out strikes. Instead of the 1715, what if we went to the 1740 on the calls? And instead of the 1600 on the April put, what if we went to the, let's say, 1575 in May? Now what we've done is we have, by going with the further out of the money calls in the deferred month, we brought the Vega factor down to minus 18. It's getting close to 0. And as time goes on, it stays rather low. So that would be the way that you can really eliminate, to a large extent, the sensitivity to this change in implied volatility by calendarizing it and using further out of the money options in the month of May. In doing so, you are taking on more margin. You'll see the margin is now 1600 as compared to the lower margin we had on the other trades. But you're also increasing your positive theta, and you are still giving yourself an opportunity to make a lot of dollars of profit with a very high yield. So there's a lot of flexibility here. And I think it's important that when you have a powerful program like OptionVue, what you can do is play around with different combinations. And that selection of different strikes in different months really does start to teach you how you want to go about structuring your positions. And it really teaches you where the sensitivity to the different Greek variables comes in. Okay, let's go back to the questions and see what we've got here. If IV is expected to rise, would a double diagonal, which is really what we're looking at, that modification, would that be better? Yes, it would be better because a double diagonal will change your sensitivity from being negative on vega to being positive on vega. And so when you have a positive vega, you benefit when IV rises. Let's see here. How did I change the vega so dramatically? Well, I changed the vega by simply putting the long wings into a deferred month. And that's what made double diagonals out of the trade rather than a simply vertical credit spread with calls and a vertical credit spread with puts all in the same month. Another question here, does it matter that the long distant month is associated with a different futures contract expiration than your short legs? A different future contract expiration than the short legs. No, it really does not matter because when you look at the OptionVue graphic analysis, it's showing you performance of that trade all the way up to expiration of the front month. So the fact that you have long options in the deferred month is okay. You're not going to hold this trade beyond expiration of the front month options. You're actually going to probably want to close it even before that. So it doesn't matter that the long distance expiration month is in place. Okay. The double diagonal can also be described as a strangle swap. You could call that a strangle swap because really what do we have? We've got a long strangle in the month of May that's out of the money, and we have a short strangle in the front month. So it's a strangle swap. It is a diagonalized iron condor, or it is a double diagonal. You can call it whatever name you want. It's still the same thing. Okay, let's see what else we have here. Would you sell back month options at expiration of the front month? Would you sell back month? Oh, okay. Well, here's the question. In this example, our maximum projection in 57 days is for the April call and the April put. It leaves us, if you hold it till expiration and these options expire, worthless. You're left with a long 1740 call and you're left with a long 1575 put. Yes, you would want to exit those unless you had the desire to hold a far out of the money strangle, but far out of the money long strangles have a low probability of making money unless you get a dramatic increase in implied volatility and or a very significant move in the market up or down. But I, again, would not even suggest holding this trade for 57 days. I would suggest exiting the trade sometime between the T plus 19 and T plus 38 line. I can even put 5 lines on this graph, and in 29 days, or essentially a month, you can make a very nice return on margin, and you may not even want to hold it for additional time because then your sensitivity to giving back profits that you've earned grows as the market moves up or down. That's why these performance curves become increasingly negative concave slope to them as time goes on. That's really what the negative gamma that you see underneath the screen is all about. The negative gamma starts off at minus 51. It becomes a larger negative number, a greater negative number with the passage of time, and that's a reflection of the concave slope becoming more steep. So there's a happy medium, and to my way of thinking, I would think that 38 days is plenty of time to hold this trade. Somewhere between 38 days and 29 days is really the ideal, the sweet spot to think of exiting the trade if the market is cooperating. Now, I did want to get into not just putting on these types of positions when you're neutral, but if you have a directional bias starting out. Because we did look and we saw that gold is in a downtrend. So you may want to put on this trade with a negative bias, with a downward bias. So a simple way of doing that would be to say, if we're thinking in terms of an iron butterfly again, we would want to look at a strike price for the options that is below the current price of the futures. So since the current price is 1655, if we want a downward bias, let's go ahead and sell the 1625 put and sell the 1625 call. Because when you're short a straddle, if that strike price is below where the futures are, it has a negative bias. You can see its delta is minus 39. So that would be a graphic analysis of a bearishly oriented straddle. But we don't want the open-ended risk on both sides. We want the limited risk, and we want to reduce our margin. So now we go ahead and buy our insurance. Let's buy the 1675 call, 50 points away, and we'll go 50 points away out of the money on the put. That would give us 1575 put. So here we have a bearishly oriented iron butterfly that is 8 deltas short, collects a huge credit of $3,800. The margin is very low, only $1,018, and it looks like this, where you can see in the short run, you make money immediately as the market moves down, but as time goes on, you make obviously greater profits. We still have that negative vega, but we do have the growing positive theta with time. And as you can see, a profit of, let's say 740 to 840 and 970 in here. These are high returns on margin. If I change it to yield again, you can see that the yield is 70 to 80% in this range. And even at an unchanged level, it's a 43% return. So there's nothing to say that you cannot structure these trades with a directional bias starting out, because that's really a good way to do it in many cases. Not too many markets are really neutral all the time. A lot of them are trending, and I think this would be a reasonable trade for someone who is bearish. If you were more bearish, there's ways that you could make this trade more bearish. Instead of selling the 1625 put and call, go even further lower. Go down to the 1600 call and the 1600 put for the body of the iron butterfly, and then go 50 points away for the insurance on each side. That would be the 15, well, let's go 40 points. Let's go to the 1560. We'll go 40 points on the call. That would be the 1640. And get rid of the other position you had in there. So now we are more bearish so that our profits are greater if the market falls all the way down to 1600, like a $50 drop. And it's very low margin, putting a far out of the money bearishly or bullishly oriented position in place. Now you get extremely high yields because you sort of stuck your neck out and you made a directional bet which turned out to be correct. So that's really how you can put on directionally oriented, in this case bearishly oriented, iron butterfly. All right, let's see here. If if implied volatility, does not rise, the value of the back month will lose money quicker. Would that be correct? Okay, that's a very good question. If IV doesn't rise, would the value of the back month options lose money quicker? Well, we're looking at the diagonal spread again. So let's go ahead and put these options into the next month out. And now, since we have them in separate months, you can see that the implied volatility on the short 1600 straddle, that vega factor is 416 negative. And if I click the month of May, you can see that the out of the money long strangle has vega of 535. So that tells us that the long options in May are more sensitive to implied volatility than the short options in April. And that's sort of counterintuitive because the April options are closer to the market than the May options. But it does tell us that we have more sensitivity to volatility in the May options. So in the event that when you look at the blue implied volatility chart, remember this is a composite implied volatility reading. It doesn't tell us anything about the individual months. However, if you go to model volatility and you look at each month individually, April and May, you can see that their volatilities are pretty close to one another. They're different by about a half a percentage point for each puts and calls. There's nothing to say that implied volatility on April options may change by 2 percentage points, whereas the implied volatility on the May options may change by something different than 2 points. Maybe it'll only change by 1 point, maybe it'll change by 3 points. Maybe one will be up by 3 points, the other will be up only by 1 point. Maybe 1 month will be up by 3 points, down by 3 points, the other one will be only down by 1 point. There is a possibility for differential changes in implied volatility between months. That is a possibility, but that's just one of the risks of calendarizing or any kinds of positions with options in different months. OptionVue makes the assumption, with the way the program is built, that you have an equal change in implied volatility for each month. But that is a good question. Okay, let's see here. Let's look at a bullishly oriented trade. A bullishly oriented trade. What you could do there with the market at 1655, if you're expecting it's going to go up, you're going to sell, let's say, the 1675 call, and you're going to see 1675 put, because that strike price higher than where the market is at. So you have a bullish orientation. A bullish orientation. And then we put our insurance in place on both sides of the market. This time, let's go more than 50 points. Let's go 75 points away. That would put us at the 17, let's see, that would be the 1750 call is what we would buy. And 70 points away on this would be the 1600 put we would buy. So now we're 6 deltas long. And clearly, the maximum profit on this trade is right around the 1675 level, because that's where we are selling our put and our call. what I wanted to show you is that not just by selling a higher strike call and putting the insurance in place, that's just one way of making the trade bullishly biased. Another way to make the trade bullishly biased is to sell the call further away, and then you've got what's called a broken wing iron condor. A broken wing iron condor. Broken wing meaning the difference between the call strikes, which is 50 points, is less than the difference between the put strikes, which is 75 points. Difference in the width of each of those spreads. So that makes it a broken wing. And since our short put and call are different, it's a condor rather than a butterfly. So it's a broken wing iron condor that gives us a little bit more of a bullish bias starting out. And you can see how the performance curves do slope upwards, and then they taper off way at the upside to a lesser degree than the previous graph we were looking at. Notice the margin on our original trade was 1460. On this broken wing, the margin jumps up to 2500. The margin or the risk is perceived as being greater because if we're wrong and the market moves to the downside, we're going to lose money more rapidly with this trade. So there is a trade-off. When you start making modifications to make it a broken wing and to bias the deltas even more, then you're going to have greater margin. Of course, you're going to have greater profit potential if you're right. So it's that old adage, the more risk you take, the greater your profit potential will be. But it does give you a lot of flexibility in terms of how you want to manage these, how you want to, structure these trades. And the beauty of it is, for every short call, you've got a long call. For every short put, you have a long put. That's why you have absolute limited risk. And the limited risk is defined by the extreme levels. When you go out here and you can see the most you can lose is $1,130 on the upside at expiration. The most you can lose on the downside is $3,630. Certainly numbers that you would not want to incur losses on, but your focus when you put these trades on must be the T+0 line. And then secondarily, you're projecting where you are anticipating things will, how the market will unfold as time goes on. And that's where you're looking at the T+19 line or the T+38 line. I never really focus on the expiration line because I'm not going to hold the trade that long. I'm only focused from today moving forward in time as long as my trade horizon happens to be. Okay, let's see what other questions we have here. Where does the graph show max loss? Well, I just showed you that. It was way on the left-hand side or the right-hand side under the P&L line. It shows you the most that the trade can lose. As a matter of fact, if I go back and you drag this green line over here, you might be wondering, well, why is the maximum loss $1,130 at that price? All you need to do is to click the letter D that you see in the lower right-hand corner of the screen, where it will show you a detailed analysis based on the wand price, and it shows you for each of the 4 component options how much you would make or lose at expiration at that price. So here was the prices we got in at. Here's the theoretical prices at expiration. You take the differences, and here's what your losses or profits are, and that's the $1,130 loss. So OptionVue does give you the ability to check any point on the graph that you wish. If you were wondering what the maximum loss in 38 days would be at that price, well, then you just highlight the 38-day line, drag the cursor over there, click on the D again, and that $330 loss is a function of the theoretical prices in relation to the initial prices on each of the 4 legs, and it's all laid out for you. So it's very clear, it's very easy to see, and the more you work with this, the more adept you're going to become in terms of deciding what strike prices you want to choose when you establish your trade. Now, one other thing I wanted to get into is if we go back to the one of the basic positions, where we say we're going to be neutral on the market starting out, for example. Let's say that was our assumption. So we're going to sell the 1655 call. Of course, you'll notice the open interest is 111 contracts, whereas a 1650 call has over 1,000. You might want to go with the more liquid. Sell the 1650 call, and then go ahead and sell the 1650 put, because that has a lot of open interest as well. And now if we go ahead and buy our insurance again at the 1700 level and at the 1600 level, now we've got our neutral iron butterfly. So what happens if the market does start to run up? Let's say it goes up here to 1693 in 19 days. What is graph telling us? It's telling us that we are now about 14 to 15 deltas short, and we're losing a little bit of money, $220. What if you then say, you know what? I'm still not convinced that this is a trending move up. I want to get neutral again. How can I get neutral? I generally favor doing the following. Rather than adjust this trade with a simple spread, I like to put on another iron butterfly that will get my overall delta neutral. And how can I do that? It's quite simple. You simply think of putting on a new position that will give you 14 deltas positive starting out at this level of 1693. And that would be easy to figure out visually, because since we did the 1650 body with the wings at the 1600 and 1700, and now the market's run up towards the 1700 level, now what we want to do is put on a butterfly that is going to be using the, let's say, 1725 call that we want to sell, and we want to sell the 1725 put, and we'll put our insurance in place 50 points away. So we're going to buy the 1775, and we're going to buy the 1675 put. Let's look at it now. Now what we've done is we have we have created a position that at this 1693 level where we adjust, now we're pretty close to neutral, and we have created a trade that earns positive time decay as time goes on, and we can easily make back our $220 loss that we had when our original trade rallied too much against us. So you notice now it has a look, I call this like the Batman trade, because it looks like bat ears and the head. But this is a very straightforward way of adjusting. It's really not even so much adjusting as adding a new bullishly oriented iron butterfly on top of the iron butterfly that we had. So now you've got 8 legs. Might look complicated, but it really isn't when you think of it in terms of 2 separate spreads. So that's the way I like to modify these types of trades. There's other ways it can be done. You can do a vertical bull put spread if the market is going up. You can do a vertical bear call spread if the market is going down. But then you start to change the dynamic of the entire position. You end up with broken wing butterflies. I like to keep them nice and pure for the most part. All right, see here. How do we adjust when the deltas become unbalanced? Well, that would be one way of doing it that I just showed, because it is the gamma that you have to be cautious of. The gamma tells you how your deltas change as the market moves. Could you comment again on that graph that I had up comparing historic volatility versus implied volatility. Okay, and the other question is, how did I select the short strikes for my second butterfly? Well, the second butterfly was a butterfly that I wanted to establish that was bullish because our existing deltas were negative, and I wanted to get our negative deltas closer to neutral. So to make a bullish butterfly with the new addition, I went with the out-of-the-money strikes. We were assuming the market was at 1693, so I went with the 1725 strike, and I sold a put and a call there for the body, and then I bought the insurance with the out-of-the-money options by going 50 points away from those short strikes. So 1725 call short, 1775 call long, and with the short put, 1725 put short, I went 50 points below, 1675 put long. That's how I came up with the second butterfly. And going back to the chart, let's go back to that chart that I pulled up. It's the price chart in the upper left corner, the second button away from the left side at the top. What I was referring to is two different measures of whether implied volatility, whether options on gold are under or overvalued. And one measure is to look at the blue line in relation to the brown line at the current level. So I click the current price where the market is at, and you can see the reading for the blue line is 10.9%. That's in the third percentile, which means it's very, very low from a historical perspective. Over the past 6 years, it's telling us that this is 10.9% reading is in the lower 3 percentage points of all the readings. Only 97% of the time, implied volatility reading has been greater than 10.9%. And so that's telling us from a historical perspective, IV is low. Options are undervalued. The second way options are undervalued in gold is to look at that 10.9% reading in relation to the statistical volatility reading, the brown line above it. That's 12.3. Since 10.9 is less than 12.3, options are undervalued when compared to how much the market is moving on a current basis. This statistical volatility reading of 12.3 is looking at the last 20 days and averaging the movement over the past 20 days, and it's coming up with 12.3%. So we have two readings that tell us option implied volatility is low, and that was the reason for my going into the variations on calendarizing these iron condors or iron butterflies, moving the long options into a deferred month to acquire positive vega rather than negative vega. So that's what that was all about. Okay. Yes, this is being recorded, and it will be available for you to view again. Okay, another question here about, did I pick the short strikes by looking at their deltas, or did I just position them the same distance above the money that the original shorts were below the money? Well, I recognized that our original position, let's just do it again. I'll go in and put it in here one more time. Our original position was short the 1650 put and call, which is essentially at the money, close to being at the money, and we had our insurance 50 points away at, say, the 1700 level and the 1600 level. So that was our original neutral butterfly, and now we're assuming the market runs up close to the 1700 level, 1693. So since our short strikes are about 43, say 40 points below the current price of the market, we now go above the market and pick short strikes at a price that's, say, right here around 720, 729. If we position our short strikes there, let's do that. we'll go to 725 instead of 729. We'll sell a 725 call, and we'll sell a 725 put. That's our body on the new position. And now the wings will be 50 points away, so that's where I buy the 1675 put and the 1775 call. So by doing that, now we end up with a position that is, on a current basis, or we were looking 19 days out, we're only about 4 deltas short. So that's really how I did it. You could actually get your net deltas to be positive by choosing a new position even further away. You could go to the 1750 and sell that call, buy the insurance on the 1750 all the way up at the 1800 level, and then sell the 1750 put to match our 1750 short call and buy our insurance 50 points away. We'll get rid of what we had before. And now we do have a position that is actually delta neutral, and it widens out the profit range on the upside. It makes those ears on the Batman curve a little bit wider. But you'll notice it also means that we're in sort of a danger zone if we overstay our welcome. If we don't want to stay beyond 38 days, because between 38 days and 57 days, the expiration graph can lead to some pretty big losses in there. So this would be a more aggressively of an adjustment, because now we're in sort of a danger zone where we need the market to move up or down slowly in order to see some benefits there. All right. When would you adjust when buying the second butterfly? When it moves away from you? And yes, that is the correct answer. It's only when the original position becomes unbiased or becomes biased, it's moving away from us. We don't want the market to move up too much. We don't want the market to move down too much. If it does, we either close the position and take our loss, or we add the other butterfly to give us profit potential, not only at the current level, but also if the market continues to move up to some degree. I mean, if you were to take this position, our original position, and simply add another at-the-money butterfly, then you're not going to really open the upside up very much. You're just going to give yourself more profit potential at the current level. But that's something you can play around with, because there's a lot of different possibilities that you can work with there. Okay, well, I appreciate everyone's attendance, and as I say, there is a recording being made of this. I do believe it will be emailed to each of you that have attended shortly after, so you'll be able to review it at your leisure. My name again was Paul Forchione. I do have a website where I market educational material, and my website is theaceprogram.com. THEACE program.com. So take a visit, see if there's anything there you would like in the way of books. I have a lot of free webinars there as well, ebooks. I've got DVDs and a variety of material. So thank you very much. I hope you got some value of today's session.